Jose, welcome back. Great to see you again.
Hey, Carl, great to be here. Thanks for having me. Good to see you.
Comps up 9+ was a beat on the street's expectations. Can you talk just broadly about where demand is right now?
Yeah, we're of course really excited about the momentum in our brands and in the business. We saw a consolidated system-wide sales growth of 14% for the quarter, 12% at Popeyes, 13% at Tim's, and 14% at Burger King. And as you mentioned, global same-store sales consolidated accelerated to 9%, led by Tim's in Canada at 11%, and BK internationally, which was really on a really strong run the last 5 quarters at 15% same-store sales growth, and digital continuing to make momentum. Proud of the work that the teams, our franchise owners and team members are doing it in a really challenging time, which I think is testament, Carl, to the strength of our brands, to the strength of our business model, to the strength of our teams and the franchise owners and restaurant team members that do this day in and day out. And one more note that I think is important is that because of the strength of our business model and our free cash flow, we were able to continue our commitment to shareholders and shareholder returns with $240 million in dividends that were paid out in the quarter, which represents the 40th quarter of growth and consecutive growth in our year-over-year dividend, and it's an industry-leading dividend, which we're excited about. There's a lot to talk about in terms of the consumer and obviously the macro challenging times. I think, and we think that our brands are very well positioned when you're facing these macro headwinds to have tailwinds in our business and in our brands if we do the right thing and continue to focus on the consumer, focus on our franchisees' profitability, and ensure that we deliver our great tasting food with great experiences and doing so at a great value.
Yeah, there's been a lot written this week about margins, especially for companies involved in food. A lot of that's packaged food, but the argument is that input costs have topped or at least have begun to decline, but pricing has not. And these companies are going to try to extend that period as long as they can to protect their margins. And that itself is feeding inflation, corporate margins feeding inflation. Is that unfair?
Look, we're seeing some pockets of moderation in commodities and labor, but we're still at pretty significant year-over-year increases across U.S., Canada. We're seeing some tremendous pressure as well internationally in Europe in particular. And our guests are feeling that pressure. And so every conversation I have with our franchisees here in the U.S. and Canada and also in Europe really turns quickly to the volatility and the pressure they're feeling on margins. We take very, very careful measures to ensure that we stay in line with CPI and expectations that our consumers have in terms of pricing. We look at a number of different data points. We obviously look at input cost, but we look at the marketplace in general and make sure that we don't get too far ahead and ensure that we provide great value to our customers. The core of our business model has always been around frequency and driving customer engagement with our brands day in and day out, and value is a key component of that. Always has been and always will be. And so we try to ensure, working with our franchisees, that we don't get too far ahead of the customer, but also make sure that we address these input costs that continue to be volatile, even if we're seeing some kind of outlooks that are more moderate in terms of the continued growth in inflation.
Shepard Smith here. Thanks for watching CNBC on YouTube.